Hello, ladies and gentlemen. Welcome to Commercial Real Estate Secrets. I'm your host, Austin Hare, and our guest is Bryson Goss. And he's a practice advisor at Healthcare Consulting. It's a company that helps medical practices like physicians and dentists run their business from start to finish with the goal of creating wealth and reducing taxes, which of course everybody loves. And so Bryson, he's been doing this for 13 years, and Healthcare Consulting, they've been in business since 1971. So Bryson, thanks for taking the time to come on the show today.
Austin, thanks for having me. Looking forward to it.
Yeah, me too. Yeah, really cool. So, a lot of our podcasts obviously feature dentists and, commercial real estate being the main thing. And then I know you guys have a lot to do with physicians and other medical practices. So I'm really excited to kind of turn over this leaf. And let's, to start out, you've been doing this a while now. I mean, 13 years, spring chicken in the industry. So like, what's your background? Like, what did you grow up doing, and like what kind of led you on this path to getting into this industry?
Sure. Yeah. So I'd say since near the beginning, always been very entrepreneurial. Actually owned a frozen yogurt,
Really?
multi-location frozen yogurt shop that we
That's
started
great.
from scratch for about 8 years. And but went to school. My schooling was in accounting. Always just been very interested in business development, the financial side of that, and then just like you said at the beginning, creating wealth and figuring out how to keep as much of it as possible and pay as little as possible in taxes.
Yeah.
Um,
Well, I
so
want to
yeah,
talk a little bit about the frozen yogurt, because I didn't know that you had that. So you said you
yeah.
had 8 locations, or you did it for 8 years? Which one?
No, we did it for 8 years. We had
Wow.
3 locations. It began in 2011, and we grew to 3 locations over 8 years, and we actually sold it 3 years ago. This
Wow.
coming November.
So
Yeah.
you were multitasking. You were kind of wearing a couple hats.
Yes, I
What was
was.
your
We
role
had.
at the froyo place?
I mean, it was me and a buddy, and we owned it, and so we had transitioned out of the operations and were really more just growing it, managing the managers, because we were spending a lot of time working with medical and dental practices,
Okay.
all throughout that time.
So if you started in 2011, you actually started it after you started consulting for healthcare then, huh?
That's right, I did.
So you were just like, man, things are going so good. We might as well just start a whole other unrelated business.
We thought it'd be nice to have something that we could call our own, and then also be able to just have a little cash cow on the side in addition to what we were doing for clients.
Yeah, no, that's great. I love the stories that come out of these shows when I'm interviewing people. So 2011, did you guys like, what was the process like for picking a location?
For the yogurt shop.
Yeah, for the yogurt shop.
Well, we actually were both in Virginia, and we wanted to come back home to North Carolina, and so we just studied the area intensely to see what was growing the most. Spoke with all the economic development folks, and just landed on spot after probably 6 months of just researching everything
Mhm.
in maybe a 100-mile radius of where we
Wow.
were looking. Yeah,
Wow, that's a massive. Sometimes those radiuses, you think they give you a lot of options, but they can just give you too many options.
that's true.
But
Yeah,
it sounded
I
like it
think
was good, right? I mean, you're happy with the location that you picked?
we were. I mean, that was our core store. It did not earn us the most, but that store had the most loyal customers, had a lot of community involvement. That was our pride store that we built with hardly any guidance from outside people.
Okay.
So yeah,
And I remember the froyo craze very well. Like there's a lot of
yep,
people talking about it, there's a lot of people starting. And it's great. Congratulations that you're able to sell, because I know a lot of people ended up closing
yeah.
down. So with this location, I mean, were you looking at street visibility and drive-by traffic, and were you focused on like the neighbor tenants that you had and stuff like that?
We really were. I mean, we spent hours sitting in the parking lot, actually observing the traffic, observing the clientele that were going into like the restaurants and the businesses around us. We spent a lot of time focused on who would be coming to this shop. What would be their sweet spot as to what they could spend for their family on a given evening to get froyo. It's some pretty detailed research that we did before we chose the location.
Man, that's great. Okay. How long was it before you started, you scaled your second one?
So 2 years later, 2 to 3 years later, in 2013, we opened our second location in the Pinehurst, North Carolina area.
Wow, that's pretty far away, huh?
Yeah, I mean, so we're in Central North Carolina, so it was only about 2 hours from us, which was manageable.
Okay.
my colleague actually ended up moving down there to manage that store because that store was doing so well. We wanted to have
Wow.
somebody there on site to at least have a closer eye on it.
What do you attribute the success to? Because at the time, correct me if I'm wrong, there was a lot of froyo places, right? Like they were getting
Yeah.
open left and right.
Yeah. I mean, we always said from day one, we wanted people to view us as being like the cleanliness and the friendliest people. We just wanted our shops to always be the cleanest, and we wanted our staff just to be the friendliest people in town.
The cleanliest and the friendliest.
Yeah, and I think it worked out. I mean, that's kind of what we strove for all the time, and I really think we were able to put a lot of other froyo shops out of business around us. I think we were the last man standing in both of those locations, just because the other shops weren't very clean. The staff members were just hanging out. Yeah.
Well, yeah, and I guess I remember it well because when I opened, I had several fitness centers, like some kickboxing centers that we put in retail locations, and the very first one that we opened up, it was next to a froyo, and so I remember talking to the guy. I got to know the owner. He shared with me a lot of his struggles that he was having, but I remember we'd go over there, we'd eat froyo while we got on our laptops and planned out, our business and stuff like that.
Yeah.
So, I mean, do you mind sharing any of the numbers? Like, were they, I'm guessing how long did it take before they got to profitability and stuff like that from when you opened them?
Yeah. I mean, so one reason I think that those shops opened up so explosively just from, so many shops is because it didn't take long for them to become profitable. Um, so we were profitable probably in the first couple months just because low maintenance, self-serve, you don't have to have a ton of staff members there. So depending on the capital, yeah, it is exactly. I mean, unless you're talking about having to put up a lot of capital, we were able to inject some money and that helped. So if you ignore debt payments, you should be cash flow positive pretty quick in that business just because it's low maintenance.
Okay. And then what about, how long was it before you had the third one?
The third one was 4 years later. Yeah, 3 or 4 years later.
And who were the neighbor tenants that you decided on this location that you decided to go to, or did you go freestanding?
The first one was the anchor tenants were a couple of restaurants. Those are the biggest tenants in that shopping center. The second two were anchored by bigger Hobby Lobby was an anchor tenant for the Pinehurst store, and then a large grocery store chain was the anchor tenant for the third store.
Wow. Okay. And so how many years ago did you say that you sold it?
We sold it 3 years ago, this coming November, 2021. Yeah.
And did you sell them as a package or separate?
We actually listed them as a package and then sold them separately. We sold 2 in 1.
Okay.
We sold the brand, which we had established, and the trademark. We established all that. We sold that to the guy in Pinehurst. And so he still operates, the name of the frozen yogurt shop was Purple Penguin. Yeah, so he still has that, still operates it. And then we sold the other two to a local restaurant owner, and he rebranded them, bought our assets, didn't buy any goodwill or trademark or anything. And he changed them to match his restaurant branding that he has. And so he operates both of those.
That's cool. And what kind of multiple were you guys able to get?
We got different for each because the trademark, and so it was a different scenario for both of those. So on the 2 that we sold to the restaurant owner, I mean, it was more of an asset sell. So there wasn't a whole lot of goodwill. But we did recognize the fact that we were cash flow positive. That I honestly don't recall what that multiple was. The store, not the original store, the second store down in Pinehurst, I think we ended up selling that for, I believe it was close to a 2 multiple.
But it cash flowed for you guys. All 3 of them cash flowed for you guys throughout the whole lifespan.
So they did. Yeah. I mean, some more than others. But
it was definitely, it sounds like it was definitely worth it.
It was. I mean, it was nice to have the cash, but it was nicer to learn. Like we just learned so much about business doing that.
Yeah. You got to go hands-on. It's just like, I'm guilty of thinking I read a couple business books and now I'm an expert, but you just don't know what you don't know until you physically get in there and try it.
Yeah. It was a good time we were at that time, we were not married. We didn't have children. We had time to just, if it required us working all day and night, we did it and it was good. And we learned a lot doing it.
Yeah, I'm sure that helps now with the medical consulting, just having the experience of hiring and firing and managing cash flow and all that sort of
It
thing.
does. It really does. Yeah.
So, obviously it was a big pivot, switching from
Yeah.
froyo to medical consulting. What like let's start with a success story. I know you and I were talking about it a little bit sooner. So like what's a case of somebody who went through and like kind of that you worked with that you've really been able to help improve their bottom line? Because I know you guys focus on kind of like the whole thing, like from tax reduction and accounting to diversifying and investments and everything. So
Yeah.
yeah, let's start with the success case.
Yeah. So, I can think of one client that a very successful business. We did not help them open the business, but they brought us in early on in their business and just lots of positive cash flow. And so that obviously generates questions. We they have multiple locations still growing. So for them, I mean, we've helped them purchase their locations. We'd like for them to own all their locations, and that's about to be the case. So them owning the real estate, that's a big one. They have to have something to do with that cash flow.
So
So being
what
able
yeah,
to rent
what
those.
what stage were they at when they came and saw you guys for the first time?
Um, I would say they were in the first 5 years of business, and
Okay.
they had started to see signs of explosion happening probably just before that, which is
Okay.
when they decided they needed
How,
some
and how many
additional guys.
locations at this point?
So now they have 5 locations.
They do, I mean, sorry, at the time when they came to you.
When they came to us, they had uh, 3 locations, one that had just began.
Okay. So they had 2 locations in existence, one brand new one,
Right.
and they started working with you guys, and now they're at 5 locations.
That's right.
Okay. So what kind of stuff did you help them put into play? Like what kind of strategies that helped them grow?
Yeah. I mean, I would say the first thing that we did is we evaluated what types of retirement strategies they were using in their business, because that's the number one tax savings vehicle for an owner, is to have some type of 401k, cash balance plan, some type of plan where they can sock away some money pre-tax. And normally that's at a relatively low cost for them from an administration standpoint and also from a staff contribution standpoint. Normally the owner is just getting almost all the benefit in those plans.
Mm-hmm.
So we always evaluate that first, because that really is the biggest tax savings vehicle in the scenarios that we see. So we did that. We helped them establish a cash balance plan, which, if you're not familiar with that, that's a plan that kind of tacks on to what you would see as just a normal 401k plan. It allows the owner of a business to put away pre-tax substantially more based on their age. So this is a huge tax savings vehicle for an owner if they have a lot of cash flow that they were going to be paying the highest tax bracket, the highest end of the tax bracket on. So yeah, so I mean, we evaluated that and put that in place, made sure that was set up, and then we pivoted to
When you say so, the 401k plan, essentially what you're saying is you go to a payroll company, you establish a benefit, and then you can do a company matching, and then the funds get allocated to a select number of mutual funds. Is that what we're talking about here?
Yeah. So, I mean, we're a third party administrator. So every retirement plan, every 401k plan has to have a third party administrator to set it up, to maintain it, to file annual tax returns, and to keep the plan in compliance. So yes, I mean, that's like your typical 401k plan where you've got a few owners, you've got staff members, there's a required amount you're having to put in for the staff that maybe match profit sharing, something like that. And then the owners are hopefully maximizing that plan and putting the most the IRS will allow them to put into it.
Okay.
Yep.
Okay. So you helped these guys set up that plan for themselves because they didn't have that at the time?
That's right.
Okay, cool.
Yep.
And what was the next thing that you were talking about?
Well, there's a cash balance plan, which kind of tacks onto that. A cash balance plan is similar to a 401k plan. It's actually cross tested with a 401k plan. And so it's the same type of thing. The staff gets some benefit in the way of contributions from the employer, and then the owner is able to put in a substantial amount pre-tax. So, I mean, every time the owner puts in $1, they're saving 40%, probably 40+% in taxes they would have paid otherwise. And instead of paying 40% taxes, they're keeping their money and they're paying a very small administration cost. And they might be paying somewhere between 2 and 10% to their staff members. So they're reinvesting in their business they're not paying the taxes on it, and they're keeping their money in their investment account. So we consider that to be a very important part
Yeah.
of the success plan.
And so does that come up as like a business expense? Because when you're like, when you go to sell and you're looking at EBITDA, like would that, count against the income?
Yeah. No, I mean, the staff portion and the administration, which again are very small relative to the benefit to the owner. I mean, you would include those probably because a buyer will often, if they're going to establish this, if they're going to keep the staff and they're going to want something similar, there's going to be an administration cost and there's going to be staff cost. But no, you would strip the owner's benefit of that out as discretionary earnings. Yeah.
So it's just an owner benefit. So essentially using this plan is a way for the owner to take out more cash, but not considered taxable income.
That's right. Yeah. I mean, they have $500,000 in profit and they're going to pay 40% of that in taxes. So if they put it to a retirement plan, they pay no taxes. And yeah.
So this is in addition to the 401k. This is a separate kind of retirement plan that
it is.
But I mean, I guess the downfall is you can't pull it out till you're 65, right?
That's right. I mean, you could structure it where you had in these plans, you could structure it where you had a real estate or something within that plan. But no, I mean, you can't, it doesn't change the fact that you can't draw unless there's a qualifying event.
So that's kind of the balance, is you still need to decide how much, whatever you're going to take and spend and live off of, you're going to have to pay taxes on. But whatever you can afford to not take out, you can essentially invest that tax-free or pull that out tax-free if you don't touch it until 65.
That's right.
Okay.
That's right. And that's just one component. I mean, that's why we say diversify. I mean, that would be one of the things we would recommend in addition to some of the other things we'll talk about.
Yeah. No, it's smart because I mean, for a lot of people that I think the 401k maximum is that you can contribute is what, like 19,500.
It is. And then if you're the owner, well, I mean,
the
IRS limit. Yeah. I mean, the IRS limit for an individual is 38,500 plus the 19,500. So in 2021, you could put away 58 grand if the plan was structured the right way.
You have to be, isn't that with I'm 33. So a person my age, I don't think I'd be allowed to do that, right? Do you have to apply the catch up rule? Like you have to be over a certain age?
No, the catch up's in addition to that. So if you're over 50, then you can tack on another, I think this year it's 6,500. So really it's, approaching 65K if you were.
Wow. Okay. So I didn't know that. Can you explain that real quick? Cause we do a self-directed 401k type plan, matching.
Yeah.
I thought it was only 25%. So we're only doing the 19.5 plus the 6, which.
So it sounds like you might have a SEP. Is that what you have?
It's just a self-directed 401k.
Okay. Gotcha. So if you have, it is based on your comp to some extent, especially. Is there anybody else in your plan or is it just you?
Yeah, I have real estate is like an LLC. It's different. So the way that I have my LLC set up is for my wife and I to draw the minimum amount of salary that we can to get the maximum amount of 401k benefits. Sure.
Yep. So, I mean, to put that deferral piece, the piece that has to come out of your pay, that's the 19.5. I mean, you obviously have to make enough to support that. It's the benefit past that where that if you're earning enough up to the, I think the comp limit in a retirement plan this year is maybe 285. I mean, if you're earning on up there and you have the plan structured the right way, I mean, you all could do each an additional 38,500.
Is that based on a percentage of the income, or is that just how much you're allowed to contribute?
It depends on how your plan is structured.
100%. If you decided to pay yourself a salary of that 38,000, could you contribute 100% of that to the 401k?
It depends on how the plan is structured. It could be structured where that so if it's a solo plan, no.
Okay.
You would have to earn more than that to be able to deduct more than that. But
okay, that makes sense.
Yeah.
All right. Okay. So you guys help them with this part of it, the cash flow part of it, the retirement part of it. And then what were some of the other steps that you helped them put into place?
We don't normally work with them monthly, just on normal operational, increasing cash flow, decreasing expenses. I mean, we do have accountants and CPAs on staff. And while that seems just like a basic thing, I mean, we structure the financial statements in a very particular way, so that we can compare it to industry benchmarks based on expense category and revenue categories, with a ultimate goal of that being to create a trend where that we could show a buyer, we could show anybody at any point in time, an underwriter, that, hey, here's the 3-year trend of this business, and here's how their cash flow or their profit has increased X% each year for those 3 years. So, I mean, the accounting is basic to some extent, but on the other hand, I mean, we're very intentional about the way that we're managing that, viewing it, structuring it, so that it's very easy for us to show a third party, hey, this business is trending in a good direction, and here's what the changes have been over the last 3 years. If you have 1 year of a dip, or you have an outlier expense that has a good explanation, I mean, that could mess up your valuation if you go to sell.
Yeah, especially if you're using like the average of the last 3 years, and you have 2 years ago you have a bad year. Yeah.
Yep. That's right. Yeah. So operational, increasing cash flow, decreasing expenses, remaining at least at or below the benchmarks for expenses by category. So that's kind of the along the way efforts we make. I mean, and then really, owning the real estate. I don't know if you want to pivot to that, but I mean, that's a big one for us.
Yeah, let's talk about that.
Yeah. I mean, we want all of our folks to have a self-rental arrangement set up, just because, we can use a local broker or use, the information that we have at hand to determine what's the fair market value rent, and then set their rent within the range, but at the high end of that, and then shuffle as much income as possible over to that rental entity.
Essentially buying the asset, the building, the location that they're operating their business at, and then charging themselves a higher rent for the tax benefits, or what exactly?
Yeah, that's it. That's the simplest. Yeah, that sentence pretty much sums it up. I mean, a lot of times there's more to it in terms of placement of the building. I mean, these medical and dental buildings are not just, you couldn't just put another business in them. I mean, dental buildings have very intricate plumbing most of the time.
Yeah.
Medical buildings. Yeah. I mean, medical buildings are typically relative to a hospital facility, and they merit a higher value for that. So, I mean, there are other things that happen as far as consulting on purchasing and building. But I mean, the goal is that ongoing rental income at the highest end of fair market value. And then the goal.
How do you balance that with the valuation? Because the higher the rent, that's going to, decrease the business's net profitability.
Yeah, that's true. I mean, so you've got to, I mean, this comes up every valuation that we do, but I mean, you've got to disclose that and just say, I own this building. If you're going to purchase the building and if you're going to purchase the business and I'm going to maintain the building, I understand that the rent's not going to remain at what it's at, because if you go ask a broker, they're going to say, this is the high end of, so yeah, I mean,
you would change,
you have to disclose that.
Yeah. You would change the lease before you sold the business.
Presumably the buyer would make you, but yeah, I mean, yeah.
And I guess the problem is then that the building has an increased value because the rent's higher. So I guess you have to decide, like, if you lower the rent, you're increasing the value of your business, but you're decreasing the value of your building.
Yeah. I mean, but I think also recognize the in-between of the cash flow does dictate the value of the building, but so does, relative to the hospital facility, newness of the facility, other buildings that could be used in place of it in the market. I mean, I think there are enough things in real estate where that you could say, yeah, the cash flow is this, but that really is just one variable in how we're going to determine the value of this building.
So in these situations, are you mostly coaching them, the owners, practice owners, to sell the businesses but keep the real estate, or is that just situational, entirely up to them?
It's very situational, depending on where the person's at in their career, what their financial goals are. I mean, we've done sale leasebacks, we've done sales of the building, sales of just the business but keep the building. It just really depends on what the goal of the person is, what the situation is.
Walk our listeners through the sale leaseback process, if you don't mind.
Yeah, so I mean, normally I'd say the simplest explanation is going to be you sell the building, you lease it back at or vice versa. One party owns the building, the other party's leasing the building, depending on what, which one you're selling, business or building. And you just structure that normally in a compromised way where that both parties are, cringing a little bit, and it's kind of a win. It establishes typically a lease with extension opportunities, which is good for valuation standpoint. Normally it's good for both parties. It has to be good for both parties, or it wouldn't make sense.
You're talking about if a medical operator owns the building that their business is located in, selling that to an investor, and the investor does leases back that building to the operator.
That's right.
And so in most situations, are they signing new leases during that transaction or after that transaction?
Typically new leases, and they're going ahead and negotiating what the extensions will look like too.
Okay. So I guess depending on the timeline, like if a doctor, dentist, if they are looking to sell their location, if they own the business and they own their real estate, but they're looking to sell their business within the next 5 years, they'd probably want as low rent as possible. Right. But if they're looking to hold on to their business for the next 20 years, then they're probably going to want higher rent because that's going to give them a higher price for that building. Right. Do you see that happening? Like, is that accurate in what you're saying? The shorter the timeline of owning the business, the lower they want that rent to be, versus the longer they're owning that business, the higher they want the rent to be. So the more they can cash out from that real estate.
Yeah, that's exactly right. Yeah. I haven't seen a ton of the sell leaseback, but I have talked to brokers here recently who say they're seeing more of it. But yeah, okay. The way you explained it is exactly right.
Yeah, because I mean, we work with clients on that side too, and we don't coach one way or the other between whether they should buy or lease. It just really depends on, like, the problem with buying a building is that it's going to take up your capital that you would most likely otherwise use to expand your business. And so real estate is a very capital intensive business. Now, of course, there's tons of benefits, like you mentioned, the long-term investing, the compounding, I don't want to say compounding rate of return, but the growth in the asset, the growth in the equity that you have from that building is all really, really beneficial. And then of course there's the tax benefits too. So there's no right or wrong way, right? At the end of the day, you really have to look at your individual situation. So talk us through like some of the benefits or that you can have from, if somebody decides to buy their own building.
So, I mean, we've already talked about the rent. You're getting the rental income at a lower tax rate. So if you're taking that money as wages from your business, let's say you were charging yourself a lower rent rate, then, you're taking more money presumably than from your business, and you're paying either self-employment taxes or payroll taxes, depending on how you're paying yourself from your business. If you can shuffle more of that to the rental side, you're dodging those FICA taxes or self-employment taxes, and you're just getting that money at a lower tax rate. You're increasing either equity or cash in your pocket on the rental side, depending on how much debt you have. And, then there could be other tax benefits depending on how you have your lease structured. I mean, you could be getting, there's something called qualified business income deduction that a lot of people will associate with just an operational business, but you could use that for rental if it was structured the right way. There's just, I don't see downsides in owning your building unless it's just a really horrible location and it's going to decrease in value. In a lot of cases, that's not happening here because they are dental and medical buildings.
Yeah, I agree. The biggest downside in our opinion is just the amount of capital that it requires you to put into it. But if you're not worried about that, you have deep pockets for whatever reason. Yeah, I think it's typically a great investment. And so do you see like a typical over under mark in terms of timelines to sell their business versus, like what I mean by that is, like if you have where you want to either structure a lower rent or a higher rent, what kind of timeline do people start switching their stance on that? Like, okay, I want to sell my business in 5 years. So actually let's go ahead and try and lower my rent versus like, oh, you know what? Like in 6 years, I want to sell. So I want to actually increase my rent higher for the next 5 years. You know what I mean? Is there a certain time frame in the future which they want to sell their business that they'll have that mentality switch from charging themselves a higher rent to charging themselves a lower rent?
Yeah, I mean, I would say we don't use that strategy, because if you disclose it, then
It doesn't
I think,
matter.
you're okay. I mean, as long as, so for example, I'm going through a dental transition right now, and they're looking to sell the building and the business.
As
Well, we
one
did the EBITDA
package,
calculation. Well, no, I mean, not, yes,
separately.
they'd like to see the buyer buy the building if they're going to
Okay.
buy the business. But yeah, I mean, so we're going through the EBITDA value workup, and the rent comes up, and they're like, yeah, there's no way this rent's super high. And we say, absolutely it is. Why wouldn't it be? It's within the fair market value range. We want them collecting the money on the backside. It's
Yeah.
less taxes, you know. So we just disclose it, and they say, well, if you're going to keep the building, then we need to adjust the rent. And the current owner says, obviously. If they're going to
Yeah.
sell the building, then they just have to figure out on the building side, on both sides, where's that compromise going to happen? I don't think we ever advise somebody to begin lowering their rent, because, I mean, if you disclose
Right. It's
what's
an
going
add back.
on in the business side, it's an add back. Yeah.
Mm.
So,
Okay. Um, yeah, I think that's great. I think, there's obviously a ton of tax benefits, ton of appreciation benefits from owning your building. So, were there any other principles that you guys put into place to help to help this particular client continue to grow and scale? I know we talked about a lot so far already.
yeah. I mean, this client still, after all of that, has a lot of extra cash.
Yeah.
So, I mean, they're looking at more complex investment strategies, tax dodging strategies, nothing illegal, just more complex
Yeah. Yeah.
things that we don't help administer. But I mean, we'll try to hook them up with consultants that we've met across the nation and say, hey, this guy works with especially high earners. He's got a few things that he's administered that might be good options for you. Um, this person rewards their staff really well. I mean, takes care of their people. They have no turnover because their people are getting
Wow.
paid. Yeah. I mean, it's just, that I think they do the right things. They're not greedy with the money. They're greedy in the sense that they don't want to pay taxes on the money. But they don't mind rewarding their
Yeah.
staff to keep them.
Nobody likes paying taxes. I don't blame them for
Yeah.
that.
Yeah. So,
Okay.
um,
What
yeah,
what's your ideal client, ideal person that you work with? Like, is there anything specifically about the size, the number of locations, the geographic location, the industry?
yeah. I mean, our firm has historically worked with clients that are in Virginia, North Carolina. We have some outliers:
Mhm.
Tennessee, South Carolina, West Virginia. Um, but all of our groups are independently owned medical, dental, or veterinary practices. And typically there's between one and, I'll say, maybe 15 owners. We do have clients that are larger, like we have clients that have 100 owners, just we don't have many of those.
Wow.
Um, our sweet spot's just a smaller, independently owned group, where that they probably don't have somebody very high level. And I mean, like, they probably don't have a CEO or somebody that they're paying, that's very well qualified to make big business decisions, growth decisions. So, I mean, they're coming to us for that. And then in those conversations, we say, hey, let's look at the tax side of it. Let's look at the real estate side of it. Let's look at the retirement plan side of it. Like, all these pieces need to work together.
Yeah.
Right now you're using 4 different vendors for all these things, which you love all your vendors. But the issue is all these things are part of an
You
equation
got to talk.
that
Yeah.
comes
You got
down
to,
to you as the owner.
all of a sudden you get the tail not talking to the head, right?
Right. Yeah. And so it's nice to be able to say, let's look at the whole picture. I don't want to say we hold our clients' hands, but we work very closely with our clients. That they probably view us as being basically a partner of their business without equity, because
Hmm.
that's the discussions that we have with them on a monthly basis. And it really
Hmm.
touching on all these things we've discussed so far.
Yeah. Well, that's great. So if somebody wants to reach out and get in touch and learn more, what would be the best way to go about doing that?
Yeah, would love for them to just call me or email me. And if me or one of my colleagues would be glad to connect with them. We don't charge anything to just talk to you, see what's going on.
Sure.
Um,
Yeah, I can put your
we're
email
fine.
address in the show notes, but do you want to go ahead and spell that out?
Sure. Yeah. So it's B like Bryson, and then my last name, Goss, Goss. So it's B Goss at HCI hyphen EBS.com, like employee benefit services.com.
Okay.
Um,
And what's the is there a website people can go check out too?
Yeah, so it's just hci-ebs.com.
Okay. Okay. Yeah. So I'll leave that in the show notes for people who are listening, so they can click on that. But other than that, it was great. I mean, I appreciate your time, and it's always a pleasure talking about commercial real estate strategies, and especially when it comes to how we can maximize the tax law in our favor.
Yeah, no doubt. I appreciate you having me on.
Okay. Well, awesome. Yeah. Well, thanks for your time. Look forward to connecting again here in the future.
Thanks so much. Yeah, have a great one.